Welcome to the Corporate Treasury 101 podcast. This episode is a combination of all the previous episodes with Daniel Sanches, an engineering director at one of the biggest FMCG companies in the world. Today, in this episode, expect to learn the full masterclass on project financing, how cash flow forecasting works, especially in CAPEX, capital expenditure, how you can use payment terms and conditions to manage your company's cash flows, and what cash flow productivity is and why it is important. As always, please rate us on your favorite podcast app, whatever it is. It helps us a lot, helps the podcast to get a better referencement and ranking. And on top of that, it makes Hussam and I very happy. So please go and rate us on your favorite podcast app. And if you'd like to, go and follow us on Instagram as well at Corporate Treasury 101. With that being said, on with the episode. Daniel, welcome to the Corporate Treasury 101 podcast. Thanks a lot for accepting our invitation. So you work in a big FMCG company. Can you talk about your experience, talk about yourself, what do you do there exactly? And then we'll go towards more corporate treasury topics.
Cool. So, first, great to be here. Thanks for having me.
Awesome.
So a bit about myself. So I have an 18 years experience in FMCG company. Mm-hmm. I'm a chemical engineer by company, but I've never done any sort of chemical engineering.
Very good.
Right? But in an FMCG company, I work as a director of engineering. I've always worked in engineering and grown my way up into as a director of engineering, where basically my main role, what I've been working and what I've lived through, is everything that is to do with delivering new products onto the market or new equipment into the factories that will deliver the new products onto the market.
Okay.
Everything has ranged from projects which are small, $60,000, $70,000, up to multi-million-dollar projects.
Okay.
I've been lucky enough to have the opportunity to work in more than 10 countries and live in more than 3. So
That's
it's a great experience.
Awesome. And so what's the director position about exactly in such companies? So you deliver product on the market, you enable the production of those products through equipment, installations, etc. What do you do as a director exactly? Is it mostly project management? Is it what do you do exactly?
So there are actually 3 key things that we look at, right? One is what you just mentioned, delivery, which is picking the idea, making it come to life. And within that, especially in the corporate treasury element, all the investment that is related to it and how that flows through the time life of the project and the impacts. That's number 1. Number 2, there's also a strategic element to it, where what we look is together with the business, we look at the 2, 3, 4, 5 and beyond framework, where we're looking at how can we deliver new products or innovative products in the best possible way. So investing the least, paying the least for it, and enabling profitability. Okay. And the third element is really the cool stuff, so to say, which is the disruptive innovation, right? Which is where we look at the technologies of the future. Not so much for the technology in its essence, but to look in terms of how can we deliver it for not only better products, but also for better performance of the company. Right? Okay.
Awesome. So the technology, not in the product itself that is delivered at the end, but how you manufacture this overall product and how the overall process behind it.
It's how you manufacture it, how you maintain it, how you grow it, right? And sometimes it's really laying out the roadmap to make things more efficiency, right? Okay. In the end, everything from delivery to strategy to the innovation is really the constant pursuit of productivity.
Awesome. Sounds interesting. Especially the third part.
I can't believe I'm the one that has to bring it to corporate treasury. So you work more as an engineering director, but you have a lot of stake in this FMCG companies in managing capital cash, right? So these projects typically are investments that the company makes. We touched on investments in the past, and you're the one that's really behind those investments, spending money, dealing with paying suppliers, paying for capital, etc. Right? So what kind of financing related jobs do you have in your role?
When it comes to finance, there's a series. You can look at it. It can be as big as you want to look at it, right? But what are the key things, right? First, it always starts with when we're looking to bring something to the market is how do we deliver best value? And that comes in the form of two specific metrics. NPV, so net present value, so what's the value of a project over its lifetime. And then the second one is really a rate of return, right? So is how much of the capital or money of the company that I'm going to invest in the next 5, 6, 12 months, 18 months, how much of that and how fast am I going to get that back, right? You can have a great NPV, you can have a terrible ROR. That's not the project you really want to do unless it's something strategic. So that's component number one, and that's the big component. And that's what typically will help us move things from the idea to life. Right?
And so just to rebound on that, what are you looking at typically? So you can have a very good NPV and a not so good ROI, so you wouldn't go for that project. What's the sweet spot you try to look at? I mean, great NPV and great ROI, obviously, I guess. Yeah. But what's the most important metric, or how do you look at that exactly?
So it's always a combination of both, right? So ideally your NPV, you want it to be positive, because that definitely makes sure that you will have a positive. No positive NPV, you don't have a positive rate of return.
Obviously.
Then ideally is when you're looking at short term, you ideally want to get your investment within 1 year, 2 years, right? If you're looking for a new to the world innovation, right? Typically you will have substantial NPV, but you're looking at the lower rate of return because the project lifetime is longer, right? So it's almost sort of a leap of faith sometimes, because longer time horizon you have less. Now, what's net present value, right? Net present value is basically it's looking at the lifetime of a project. It can be 1, 2, 3, 5, 10 years. Looking at the incomes that project will generate, so how much money will come in. Looking at the outflows, right, which is the expenses associated to it, the capital investment in year 1 or year 2, the depreciation associated to it, and basically looking at all that mass balancing and then discounting it to today's dollars, right? So it gives you a positive value if it's a positive generating project,
ideally,
or indeed, or a crappy project in case there's a negative NPV, right? Rate of return, the way that it's typically looked at, is how much of that investment that you put into the project you're actually going to get paid back year on year, right? So, and it comes in a percentage manner. So the higher the rate of return, the higher you get your money back. So typically it has an indication that the better the investment it is in terms of return for what you put in.
Okay. Do you have standards, like how much you expect on the rate of return? Like there is this concept of weighted average cost of capital that companies use to say, okay, if we invest something, we expect at least that many percentage of return. Is there like a standard in the industry of FMCG? What are we looking at in this kind of project?
Numbers that we normally aim for. So you would look at it in different categories of projects, right? So projects where you want a meaningful impact, something that is going to hit your productivity this year or the next 2 years, you want to have a high rate of return. So the bigger the percentage, the more likely that project is to be selected amongst the ones to have an investment.
Obviously.
When we look at strategic projects, right, the numbers I've seen and we've worked with typically is we're looking for 15% and above, right? But these are strategic projects, right? And we're talking about big established companies, right?
Absolutely.
Which is a big boat that you want to keep the momentum in the right direction.
And so that's super clear. And just to come back on that NPV, the discounted is, as you mentioned, Sam, is the fact that we take into account the time value of money, and so we discount what the money will be worth in a year or in 2 years or in 3 years, etc.
So it's not as simple as it's going to cost this much and you take out this much. So it's going to cost this much and make you this much. You also have to take into account that the money in 3 years is worth less than the money is right now. Right. So if you're going to spend, let's say, $1 million every year, the money that you spend in year 3, the 1 million you spend in year 3, is worth more than that right now. Right. And that's, you'd rather have the $1 million right now and spend on something with a higher return on it, for example. So you need to make sure that it's better to spend that $1 million in 3 years that you hold now for in 3 years on this project versus putting it in the bank with an interest rate or something like this. Right. That's why it's not as simple as money in and money out. It's also the discounted value of time. Exactly. Oh, interesting. That's cool.
Super clear. How do FMCG companies usually fund their projects? And so you touch upon engineering project mostly. So they, I guess, another department comes with, look, we are looking into introducing this new project on the market. Can you please enable it? So you do so. And how do you fund those projects exactly? How does it work?
The way we typically fund projects, so most FMCG companies are self-funded, So what does that mean is when you're looking to invest, and this is really for capital projects, right? So a new factory, a new line, a new product that requires technology.
Okay.
And what does this mean? This means that you're actually funding your investments from your yearly cash flow.
Okay.
Right? You're funding this from the income that is coming into the company last year, the current year, etc.
Yeah.
And so that's how we typically fund.
Okay.
Right? If it was to be a smaller company, it's different, right?
Yeah.
Because smaller companies or startups, typically the way that you'd be looking at it is you don't have necessarily reserves. You don't necessarily have huge cash flows or incomes, or you don't have cash flows at all. So then typically you look at either for issuing debt or issuing equity. Those would typically be the two instruments that you'd look into.
Okay. Wow. And so the size of the company enables it to fund all its projects around the world with its own cash flows. I mean, with its own funds.
Normally, yes.
Okay.
Normally, yes.
Wow,
right.
That's
That's what's important, in especially if you look at the FMCG industry, right? It's not disruptive. It's not tech. It's not. It's not a 20% index growing business year on year, right? So what you're
even
trying,
though in the latest years some industry does pretty well.
two special past years, indeed. But what you look is what is looked at externally at these companies is consistency, right?
Okay.
And consistency, you're looking at it not only from the cash flows, but also how you're putting investment, but also in terms of the lot of debt. You're looking at total shareholder return. So there's a big story behind it in terms of how you manage, and that's why the best way for an established company to keep momentum is to, one, have the adequate cash flows to be able to fund its maintenance, but also its future growth.
Okay. Amazing. And so everything is self-funded at the engineering level. How does it work exactly? Like in the project funding, what's the role of engineering there? Will you say, okay, look, we want to make this new project, but we need that much amount of money in order to enable it? What's the role of project management, engineering, and the director in this concept?
The first part that we actually take is we're involved in the early phases of a project already, right? So if a product is conceived and there is a certain level of market research that you know that this has a high probability of moving forward, we step in as engineering, right? We step in to understand what is going to be needed to make this come to life, right? What's the technology that you need? What's the size of the factory that you need? Where are you going to produce it? And obviously all these inputs then come out with the number, the capital investment number, right?
Okay.
So when you're in the early feasibility and definition phases, we're there to provide that range. And that is a super important range for the two factors that we talked before. Defining the net present value of the project, right? Because that capital investment is a big hit in the first 1 or 2 years. It's a negative balance on it. And then obviously that then generates the rate of return.
Okay.
So that's our first step when it comes to feasibility. If the project passes those financial hurdles or that criteria, right, and then everything keeps on supporting it, so further market research, further product feasibility, etc., our job then starts coming into the delivery element, which is, instead of providing a range, we look at what technology specifically is it that we're going to use. How much does that cost? What does it take us to buy it, ship it, install it, start it up, right? And making sure that everything that's around it, right? So it's not only equipment, but it's also the facilities, could be land, could be a series of things, right? But everything that is related to the one-off investment that you need to do to make this project come to life. We build an estimate. We build what is called a budget in the end will be the final element that will allow us to really confirm to the business, this is what you really need.
Okay.
And then the business really takes a decision. We move forward or we don't move.
Okay.
That comes to the decision gate. And then in the last part really is during execution. Our job is super important because we need to understand, one, are we within budget or not? That's number one. Number two is if our project lasts beyond 3 months, 6 months, a year, 2 years, it is super important that we understand how our spending flows throughout those months. Because whatever we spend is money that we're effectively taking out of the company's pocket.
Yes.
And so the company needs to know what they can count on or not in terms of our spending throughout the years. So we manage not only are we within budget or not, but also are we within what we're planning to spend.
Okay.
And so this is where it gets interesting for our corporate treasury listeners. You're essentially managing the investment budget of the company, or a portion of it, right? So a lot of FMCG companies, a lot of companies in general have very big, let's say, research and development budgets, which engineering is part of as well, but then also into delivery and investing in capacity increases. So say your market is growing, you need to install more factories, you're the ones spending those millions of euros, dollars, etc., right? And your cash flow out is significant to the company's overall balance sheet, right? What's capital expenditure? You mentioned capital specifically. What's that, and what's the opposite?
Capital is the money you need to buy a piece of equipment, the money you need to buy a piece of land, the money you need to buy people to install that piece of equipment, the money you pay your engineers to design it. So that's what's capital. Why do we call it capital? It's because this money that you end up paying ends up being the final value of the asset that you implement, right? So once it becomes part of the final asset that you implement, then it becomes part of the ongoing expense in terms of the depreciation. So capital is every single effort and asset that you buy that will translate into something physical that is used to produce your product.
And you can depreciate that asset over multiple years.
Yes.
Right. So you don't have to spend all. So you spend all the money then, but then the value of that is taken off the books over time. Right. So there's a bit of accounting.
So your capital impacts. So what you spend to buy on that year impacts your cash flow directly.
Yes.
Your depreciation will become an ongoing expense. So your depreciation over year 1 to year 10 to year 20 will impact the future year cash flows of what the company will have.
Okay.
So the capital is the amount of money that is used in order to implement the structure that will be used over the years to enable the project. And in that, you squeeze in also the people that build it. Those are part of the capital expenditure. It's not like operational expenditure, which is the other one. This comes into the capital as well, so you can depreciate the labor amount of money as well.
The objective is not to depreciate the amount of labor as well, but the objective is also to drive efficiency on it, right? But the truth of the matter is, when you buy a car, right, the price that you pay for that car, which becomes your asset, that includes the price of the operator that built the car. It includes a fraction of the engineer that designed that car, right? So in companies, you have to translate those same efforts into the equipment factory that you will have, or the factory that you will have on the line that you have to operate.
Okay. Very clear. So we touched upon cash flow and capital and the difference. So the cash flow you just mentioned, the amount of money you spend is literally going out of your pocket right now, but accounting wise, you're going to depreciate it, so it's going to be written in the books over the years. So we would like to go into a little bit more into cash flow. And I think there is a cash flow target mentioned into those FMCG companies. They have a cash flow target yearly. Can you walk us through what that is exactly?
So before talking, so why are targets important on cash flow? Cash flow can be used for a series of things. Typically, companies use it for paying dividends, if they're paying dividends, right? Buying back shares, right? Which helps them obviously bring in further value. They can be used to create reserves. Reserves can be used to create acquisitions. So, right, when you're looking to grow your business and you want to acquire competition or a startup, you need to have money in there. You need to have money somewhere stashed in a drawer, right? And then basically capital is the fourth element of that, right? So, which is in the end, it's the bloodline to keep your business growing. If you invest it from your cash flow and you've invested in a wise manner, right? You can keep your business growing, you can keep your cash flow growing, and you can keep on fulfilling the other three I mentioned, right? Why are the targets there? The targets are there because, as I mentioned before, FMCG well-established companies, they're like a big boat. From a shareholder, from a market value point of view, from a trust point of view, right? I'm always talking about investor relations. You want to keep the momentum. Ideally, that momentum is not a flat momentum, but it's a growing momentum. So that target is to ensure that what is being done year on year is allowing you to do those four things. Pay back your dividends and ideally grow them on the basis. buy back shares.
Okay.
Right.
Why would you do that?
You buy back shares. There's a series of reasons you can buy back shares, right? So big companies typically offer compensation or certain portions of compensation in stock options. Right?
Yes.
When those get exercised, the company needs to either buy them back, right, or give them to the employees. Ideally, there's a recurring in which they buy back. So there needs to be a certain amount of cash flow dedicated to that.
Yes.
Number two is buying back shares is also one of the best ways to provide shareholder return. What does that mean is, as you reduce your number of shares on the market, and if your earnings is growing, your earnings per share will grow.
Indeed.
Your shares will become more attractive. Your market cap becomes more valuable. Your company becomes more attractive, essentially, right? And that has a series of implications. And I think you've talked that before. One is for financing reasons, for sure, right? But then obviously from a shareholder value, that's truly desired.
Okay. And so where do they end up exactly? Just out of curiosity. So a company buys back its shares, so it becomes equity. I mean, it was equity. What's the mechanism here exactly?
When the company buys back its shares, it basically takes them away from the market.
Okay.
Right. So it privatizes them, so to say. It
Okay.
burns them away.
Okay.
Right. So if there are 10,000 shares of a company out in the market, and in a specific year the company buys 1,000 of them, it's not that you still have 10,000. No, you will have 9,000 of those out there.
Okay. So basically, on the financial statement, we will see less equity because this equity is no longer.
You will see less number of shares.
Yes.
But in principle, your equity, your value, your dollar value should stay the same or higher.
Okay.
Depending on how your earnings are going.
Because the earnings per share is what gets adjusted there.
That's right.
Exactly.
Less shares, same earnings, or greater earnings makes the ratio even better.
Yeah.
Okay.
We bring it back a little bit to corporate treasury.
Yes, sorry, that's fascinating. So that's why
the cash flow, right? Cash flow is one of the pillars of corporate treasury that we've defined in our first episodes. Cash flow we defined as the availability of cash, right? So by definition, spending that cash makes it less available. So when you say we impact cash flow, as a engineering director or as an engineering department that's investing in capital projects, right? We said. You're negatively impacting the cash flow. You're reducing the amount of available cash the company has because you're spending it.
Correct.
Right? So you have a cash flow target, and you explained that the reason for that was, why is the target so important? Why do you need to declare a cash flow and stick to it?
Two things. Targets are important, especially for public companies, right? Yeah. Companies that are out in the market, that have stocks, that have shareholders, right? And because performance is, whether we like it or not, performance is managed and looked at on a year-on-year basis.
Obviously.
Those targets are set up on a year-on-year basis, right? So if you have a certain percentage of free cash flow that you want to generate year-on-year, right? That percentage is what allows you, as I was mentioning before, to pay dividends to your shareholders, buy back your shares, continue to build ideally your reserves, but it's also what then allows you to make sure that you have the right amount of cash for the next year to keep on investing back into the business and growing it, and self-fund your projects.
Okay.
Indeed.
So the cash flow targets are important for all that. So it's not only giving investor confidence by showing that you set a target and you hit it, but also so you can project what's going to happen next year. Right.
Exactly. You know that you're protected in terms of what is going to happen next year. Then obviously it's not only a year-on-year base, because investors and trust in companies comes from a history of performance, right? So that history of performance, that history of targets, and the value that you're generating is what keeps on giving the boat the momentum it needs.
You're not looking quarter to quarter; you're looking year to year or years.
Year to year is very, very important. Right. When it comes to investors, quarter to quarter might be important to read into the signals. Yeah. Right.
To see directionally.
To see directionally how things are going. Right. But this is where this is more financial analysis more than corporate treasury.
Indeed. Okay. What we like to do in this podcast is, well, obviously talk about the what. What is it? Cash flow targets. Why do you set them up? Now, we like also to ask, how do you do that? Like, how do you say, okay, this year we're going to have these cash flow targets? How is it set exactly in FMCG companies?
So, like everything, so the first thing is we plan, right? That's what we do. What do I mean by we plan? The part that we plan is we forecast. So, we're not working today on the project we need to do tomorrow and working on tomorrow the project that we need to do the day after.
Indeed.
Right? As I mentioned before, there's the strategy element where we do have a vision of 2, 3, 4, 5 years out. Right?
Okay.
So there is, let's call it what would be the short-term forecasting, which would be the forecasting for the next year.
Okay.
Typically, it starts well ahead the beginning of the year because you have to go through the iteration process,
Yes.
right? You need to understand how many projects are on my wish list, right? Or what do I want to do on my wish list?
Okay.
What is the business planning to do, right? Are these two matching? Right? And then taking the decisions so that we can firm up what actually is going to be the budget for the next 12 months.
Okay.
And that gives us the forecast for the next 12 months in terms of what am I going to spend from January to December. Okay. That once we have that narrowed down, that allows us to tell the business I'm spending 2 million January, 3 million in February, etc. And the business from there can forecast the remainder of their cash nets or cash outs to predict what the cash flow is going to be for the company. And are we within target or not?
Okay.
Then you also have the long-term investing, right? Because as I mentioned before, not all of our projects are month-based. Some of them are year-based, right? Also, consumer products are forecasted on a growth basis, right? Is how much is it going to grow in the next 24, 36, 48 months, right? So that also needs to come into the picture, but more of a strategic element, right? So what does that tell me? It tells me if a product that I want to make in 2 years' time will no longer have enough capacity or equipment to produce it, means that at a certain point in time, the company needs to take a decision.
Yeah.
Either we stick with what we can make and we won't sell anymore, or we decide to invest. And those type of investments have a longer time horizon.
Okay.
Right? So that's what I talked about. The plan, there's the short term, and that's the 12-month, and that's really what matters 100% from the inputs into the company's financials. And then there's the long term, which is what allows the company to take the strategic decisions. Okay. Planning is relatively easy. The second part comes to executing, right? Basically what we mean by executing is executing and monitoring. We set up a plan for the 12 months. So then we have to look at what is our process going to be from daily, weekly, monthly, quarterly and yearly basis to make sure that every single project manager knows what she or he is spending, right? How is that relating to the forecast? And how are we managing any specific changes, right? And this needs to be done, like I mentioned before, on a daily, weekly, monthly, quarterly and yearly basis because there are changes. The business is dynamic, right? Things start, things stop, things get delayed, someone falls sick. A whole bunch of reasons for which these need to be managed, but because there is a target, and because the consequences of not meeting that target could have an impact, these changes ideally need to get managed. Right?
So it's not only an exercise that you plan super early, so even before that the year comes, part of the long-term planning that happened some years ago, because you look at for coming years. You also need to be super accurate when you start the fiscal year, I imagine, with the setup of the targets. And then you need to monitor and direct to drive the big boats, as you just mentioned. Okay, and I pretty much like the concept of wish list. So you have a list of projects, of which I guess you look at the NPV and the ROR that we just talked about. And then you select the projects you want to implement for this year, and you set up the cash flow targets according to those. That's pretty much it.
The cash flow target is set up ahead. Right? Because most of these companies come with a series of histories, right? And they come with a long-term vision. Even before I started in the company, right? These targets are already set up typically, right? Or they're very, very closely set up. Yes. So that doesn't mean that from an investment point of view, 1 year I can do 500,000 and the other year I can do 20 million. No, not necessarily. It needs to be within a standard, right? But as I mentioned before in the year, that early planning part of the process, the process is iterative, right? And as I mentioned, the business does make choices. So there are moments in which sacrifices might be made because there is a strategic investment and that needs to come with communication. Or if we're in, let's call it normal growth mode, right, is what are the choices that need to be taken to either one, a project that I need to take off the list because it's hurting my cash flow, or maybe a project that I need to put into the list because it will help my productivity on that specific year.
Okay.
Right? So it's an iterative process that goes until the moment in which we really need to close the books and say, this is going to be our year.
Okay. Can you take out a project after it has been started? Like, okay, this actually doesn't bring at all the NPV or the ROI we were expecting, or all of a sudden we foresee that the product that was meant to be out of this project is not going to be sold anymore because there is a trend change whatsoever. Does it happen to stop a project?
Anything can happen. Yes.
Okay.
Yes. To completely stop a project, small scale projects, that can happen a lot of times.
Okay.
It happens in early phases of the project. Right.
Okay.
So, as I mentioned before, and I'll keep on mentioning this, it's in established companies, right? Yes. There is a tendency to be very conservative when it comes to cash flow impacts, when it comes to impacts on the treasury, right? It can happen late in the process as well, but that's more rare.
Okay.
It more often happens that it's not necessarily stopped, but delayed, right?
Okay.
Than anything else.
Yeah.
And you can even do you ever move projects around, like even slow down the execution of a project to help your cash flow targets a little bit, or speed them up to help your cash flow targets? Like
the project themselves, no, right? I mean, typically, when you have a market window where you need to launch, launch. No, there's no going back, right? Customers are counting on you. Consumers are counting on you. You do not want to break that trust. That's what pays our salary at the end of the month, right? But within the engineering framework, within the project management framework, there are ways in which you can handle that, right? You can either put projects on hold, which are maybe not externally impacting. So a productivity project, which only impacts internally, you say, okay, I'll slow this down because the productivity hurt or the cash flow hurt is going to be too much. Or you can accelerate projects that might have been in the pipeline for the next fiscal year when there is a clear opportunity, right? Okay. So imagine there's a huge bump up in the sales of a company and you want to make use of that momentum to build in further growth. You have that opportunity. But once again, these are always decisions that get taken at a high level.
Okay. Super clear. So I guess the challenge here is not only to set the target, but then to achieve them with as much accuracy as possible. How do you do that how does that translate into your job, the day-to-day job, or as a director in engineering?
So we talked about the plan, we talked about the forecasting, right? But these organizations, my organization, they're big organizations, right? Yes. You have 10s, 20s, 30s of people who are managing different projects across different regions, right? So in the end, it's a process where things start at the lower level, right? So let's call it's maybe either a specific product or a specific region where you have that drumbeat that I mentioned before, weekly, monthly, and people are looking at where are we versus target, what are the deviations, any possibility to compensate, right? So it's a dynamic process. And in the end, it's as simple as sitting around the table, looking at the data and taking the decision. Then basically that process has to get scaled up. It has to get scaled up in two directions. One, you need to go from the local level, whether it is country, product, platform, or regional level. It needs to scale up to the global level because in the end, corporate treasury in a big company is global. Every region has its impact, right? So we scale up in that factor and then pull up the number into the specific target that company has. And then the other factor that we scale up is throughout the year, right? Monthly is important. Quarterly is a higher level of importance. Yearly is super important. Right? Because in public companies, you do issue official reports on a quarterly basis. So that's where you want to make sure your indications are right. Right? And then obviously when you close a year, that's when all the cards are laid out on the table.
And so touching upon that, you want to be as accurate as possible. Do you also seek going above target? And by that I mean either spending less or earning more, or do you want to remain into that specific window that has been set no matter what? So you won't look at, it seems that we are not spending as much as we expected on this project. It could be seen as a super good thing because you are spending less, so the ROI will be better, the NPV will be better. How do you monitor this exactly?
This is the importance of the scaling part, right?
Okay.
Because it's not one project that typically drives these companies, it's multiple projects. So
Of course.
indeed, there are always projects that are spending less, always projects that are spending more. But the scaling part of moving from the local level to the regional and global level is super important because in the end, it's checks and balances at the end of the day, right? And the sooner you are doing that process, and that's why it's important to do the monthly drumbeat, the sooner you can intervene, right?
Okay.
So what you want to do is the ideal way that the cash spends is you see a linear chart from the bottom left to the top right where there's your 100%.
Yeah.
The matter is that fluctuates over time. That
Okay.
scaling and that looking at where a project is spending less or a project is spending more allows the right people to take decisions, right?
Okay.
Either we stop, we start, or we accelerate.
What's wrong with spending less? That doesn't make any sense. Like, surely spending less is a good thing. You said, like, we need to check if someone's spending less and then compensate. Like, spending less should be a good thing at a company level, right?
There are two things. So spending less is always a good thing, right?
Okay.
But the way, and now I'm going to talk with an engineer's hat on. Yes,
Very good.
engineers,
Please go for it.
we're freaks. Yes. Spending less consistently means that there's something wrong in the process, right?
Okay.
So what are you doing is, imagine 50% of your projects spend 50% less. I'm exaggerating, yes, but for the sake of the exercise.
Perfect.
At the beginning of the year, you've told externally you would be spending something from a cash flow target. It didn't necessarily say that it's going to be project XYZ, right? But your capital projects spend 50% less, and you end up at the end of the fiscal year with that amount of money spent less.
Yeah.
That is a lost opportunity for the company throughout that year, which already the company was counting on spending that money, mainly on capital projects, but it could have been spent on several other activities. It could have been spent on discounting product to sell more.
Yeah.
It could have been spent on R&D for new products, right? So
Interesting.
it's good to spend less when it is intentional. It's not good to spend less when it happens by chance,
Because
right?
the company loses out on spending that money on something else because you said you would spend it this year. So they said, okay, we're not going to touch this money. If you come back and say, hey guys, I didn't spend it. They're like, well, we're glad, but we could have spent this money on something else. Instead, it's just cash sitting in our bank account.
Indeed.
Okay.
Indeed.
That's a good
It's
reason.
absolutely correct.
Okay. Makes sense.
Yeah.
So the objective is more, you had a target and you missed it. So you said, I like this idea of something wrong with the process. If you're consistently spending too little, you're setting the wrong targets. And then the faith in your company's ability to project manage, your faith in your company's ability to do what it says, even if it turned out positively, but in that specific context, do what it says could be hampered.
Yes. If it happens repeated, for sure, trust gets eroded, right?
Very clear. Anything else you would like to add to help us better understand the implication of cash management? Because this is what we're talking about here: cash flow forecasting, cash flow spending. As a project manager, anything else we missed?
I think the only thing is, as project managers, but mainly as it's called from an engineering point of view, the other thing that we need to take into account, it's not only capital that has the direct impact on cash flow, right?
Okay.
There is an organization behind it.
Yeah.
Right? And as I mentioned before, early on in the episode, I think I mentioned one of the things that we do is it's the endless search for productivity,
Yes.
right? So it's not only the management of capital, but it's also the management of resources, right? So the amount of engineers you need, the budget that you have to manage those engineers, that is not necessarily project related, right? That is also very, very important, right? Because that, even though that does not impact your cash flow, it does impact your overall budget for the fiscal year. Right, so it actually tells Daniel, I've spent 100,000 last year. What's my ability now in the future to spend 98, and in the future to spend 96, and in the future to spend 95, whilst delivering my cash flow targets, whilst delivering the product innovation, whilst delivering the projects needed. Right, so it's not only about making things come to life on the shelf, but it's also how to manage an organization, and an organization in the end is an expenditure for the company, and an expenditure, as you know, impacts corporate treasury.
Yeah, absolutely. Super clear. We'd like to touch upon payment terms to supplier. Payments are, well, obviously at the center of corporate treasury as well, right? It's the money going out, so you need to foresee, plan accurately, etc. What are typical payment terms and by that I mean in terms of delays or anything else that could be relevant for corporate treasury with the suppliers in FMCG companies?
I'll talk it in two aspects, right?
Okay.
Because there are payment conditions and then there are payment terms.
Exactly.
Right? So because I could decide when you buy a car, normally, I mean, if we're well funded, you buy the car cash or check, right?
Yeah.
You pay it immediately. If you can't, you'll buy it with credit and you'll pay it over time.
Yes.
Right? For a company, the best way to do is to always pay over time, right? And so those are payment conditions. So when we're buying, when we're going to build a factory, you're not going to pay for the whole factory as soon as you say, I need a factory, right? So that's the first part that plays into it, right? And so the payment condition, so to say, is when you're looking for a big piece of equipment or you're looking for building a factory, you want to build trust with the person who's going to give you.
Yeah.
So you do have a down payment, right? You want to facilitate that person to buy their materials and start assembling, right? So, and typically it's I got ahead of myself. It's typically split into three parts, right? You have a down payment, which makes sure that the individual or the company that needs to supply to you something has their cash flow to buy the materials and start the work. The second payment typically will come when there's something that is already delivered, is built. You might see the piece of equipment or you might see the building completed, right?
Okay.
And then you have the final payment, which comes to performance, right? What you've asked for actually does what is intended to, okay? And so that's an important part of the project manager's forecasting process, okay? Because then she or he will know what goes out in July, what goes out in September, and how much will go out in November, according to how their plan has been. Then there are the part which you mentioned, which are the payment terms, right? Which is we can decide to pay suppliers on immediately. We can decide to pay suppliers on 30 days, on 40 days, on 50 days, 60 days, depending, right? And that typically comes in as well as a negotiation tool, right? So what does that do is that means that even though we've sent out the payment for that supplier, there will be a delay from the moment we've acknowledged to the supplier that we will pay them to the moment that money actually comes out of the bank, right? And that gives the company, that gives us those 30, 60 or 90 days of extra time in which that money can actually be applied on something else that drives more value.
Okay. Wow. So that's, and typically you talk about those 20, 30, 40 days. What are we looking at in FMCG? Like, would you like to, I guess the farther in the future, the better, because you can sit on your cash and use it for more meaningful project. I mean,
you can gather interest on it to the bank, for example, for longer.
Invest it, etc. So the farther, the better. But what are we?
The further, the better for the company who is paying, right? The further, the worse it is for the company that needs to receive, so
obviously.
To say, right?
Okay.
The payment terms, or the amount of time that you can actually extend it, can come in two manners, right? A company that usually comes to this supplier every single year and knows that they're going to spend, typically they would not have an issue in paying 60 days or 90 days. 90 days is already probably to the extreme.
It's a lot
in these types, right? But 60 days is something that you'd see usual.
Okay.
Why? Because that trust is there. Because the trust is there, and probably because the financial institution that supports this supplier knows and understands that this money will come in, right? So they can actually tap into their lines of credit if they need to, or whatever it is, right? Instead, if I'm a new company, I'm just coming into the business, and I go to the same supplier and ask for exactly the same thing, and it's the first time you come in, you're going to need to pay everything now.
Okay.
Right? So there's a lot of it that is related to trust. There's a lot of it that is related as well into weight in the market.
Okay.
Right? So more established companies have more leverage in terms of the amount of time that they can delay to pay. Younger companies have less, obviously.
Okay. And so when you're looking at establishing a new relationship with a new supplier, then the payment terms will be adjusted compared to the traditional 60 days or even more in certain cases. But so starting a relationship means adjusting a little bit your payment terms, and then when you have built trust, you can further extend the payment terms.
Could normally mean adjusting the payment terms, right?
Okay.
But don't forget you have the two levers.
Exactly.
Because you can either use the conditions or you can use the terms to leverage both of them.
Yeah.
to manage your cash flow out.
To manage our cash flow out, but also if it's a supplier who we really want to work with, right? We need to understand if there are any trade-offs. And then it's the responsibility of the project manager to then understand, okay, can I compensate this through something else?
Cash flow.
Yeah.
Okay. So it's a combination of, do you trust the supplier? Do you really want the supplier? And then you maybe give him more favorable terms. You're willing to pay more upfront. And if you're like, well, actually the supplier I know can sometimes give me bad equipment or bad services, so actually I want to change my payment terms to be later until they've actually given it to me.
Exactly.
So it's also, so do you have different suppliers with different payment terms, not only on how long you've been with them, but also on how much you trust them? Like you as a project manager trust them, or how good you think their services are?
Yes, that can happen.
Really is at your level as a project manager to decide, or?
Typically in big organizations, you do have a purchasing organization within it, right? Okay. They are the people who lead and who are actually legally enabled to have these conversations, right? Okay. The role of the project manager is to work with these satellite organizations, so the purchasing one, as you rightly mentioned, Hussam, to then liaise with the suppliers, right? So obviously in big corporations, the individual needs to be always taken out of the factor, and the project manager, being a person who has access to a lot of capital, needs to be taken out of the factor from a stewardship point of view, from an accountability point of view.
Okay. And you mentioned this other really interesting aspect as well, which is, so you could come in with a supplier and say, hey, look, we're going to give you a down payment of, let's say 30%, right? That's going to be once we issue the contract, right, to start our services agreement. Say you're buying some equipment from them. You say, okay, we're placing our purchase order with you. Down payment is 30%, but it's a 90-day payment delay, right? You said something about they can then get line of credit against that.
So there are two things that actually can happen, right? I think you guys have mentioned this in one of the previous episodes, right? So a company normally will always have a line of credit to fund your short-term financing, right? So suppliers will normally have those, right? So if they know and they can show let's call it the receipt that we are going to give them for the down payment, that typically facilitates for them to tap into their line of credit and ideally either not pay the interest rate or something. The other thing that some FMCG companies have is, because they are big companies, huge cash flows, they work a lot with financial institutions. There is something which is called supply chain financing, right? Which is what they do is they actually, instead of using the supplier using their line of credit, they can tap into, let's call it an innocent line of credit, supply chain financing, backed by the company that is buying the piece of equipment, where they pay, I'm going to say symbolic, but they pay a very low level of interest rate, right? So that actually allows them to pull their cash forward. And then when those 90-day time comes, it actually goes to the financial institution. But the supplier at the same time has had all the money that they needed to start their prep work.
Okay. So supply chain financing is, just to summarize then, so you as the FMCG company or a big company, right, are buying something from a smaller supplier, let's say, right? That supplier, you have a payment term of 90 days on that. So as soon as you say, hey, look, we're going to pay you, but we're going to pay you 90 days. Then there's an intermediary, like a financial institution, like a bank, which would say, hey, we know this big company, we know they're going to pay. So you can borrow money from us at a lower or better interest rate than a normal loan would be, because we have this guarantee from this bigger FMCG or cash or big company that says, hey, look, this is going to be paid in 90 days. So that smaller supplier can get the cash earlier with a much better interest rate.
Yes, exactly. Exactly.
So, and you call it supply chain financing.
It's supply chain financing.
It's really interesting.
Yes.
We should do an episode on that, Gil.
Absolutely. What you just described is factoring, and that's a very good idea of episode. Definitely, we'll touch about that.
Future.
And just digging just a little bit deeper here, how does it work the other way around? So the FMCG industry, typically your clients are retail companies, the ones that sell the product to the end customer, right? Do you know about the payment terms of those? Because retail companies are known to also have very long payment terms. So how do you sit in between the suppliers to enable the production of your products and the retail companies?
I do not know the specifics,
okay,
but I do know that in the end, the balance is that we try to pay our suppliers as further away as possible.
Indeed.
And we try to get paid as fast as possible.
Obviously.
That's also just to make sure that our
overall
balance is more positive than negative.
Okay, makes sense. And have positive cash flows. Fair enough. So another topic we'd like to touch upon, Daniel, is the concept of free cash flow productivity and how there is overall strategy around that. Some FMCGs companies really put that forward, even on their websites or such a thing, to say, look, we have a very good free cash flow productivity. Why is that? Why is it something that companies look at and put forward in their communications?
Free cash flow productivity is, in the end, is the free cash flow divided by the net earnings that the company has, right? So that's where the percentage number comes in. And it's an accredited accounting measure that public companies are mandated to have to a certain extent, yes? What does that measure tell you? That measure tells you is how much, in the end, how much money is the company generating and is able to either set aside for whatever purpose it wants to versus the money that's coming in, right? So the higher that percentage is, the more, the healthier a company status is, okay? That percentage target gives a series of signals, especially to investors, right? The ability of a company to, one, sustain its payment of dividends and ideally grow over time. The ability of the company to buy its shares back as part of the total shareholder return model, right? The ability of the company to build its reserves, right, for acquisitions or future investments, and the ability of the company to fund itself, right? So as we mentioned before, how do FMCG companies typically fund their products? They're self-funded. So you want to make sure that bloodline is there year after year. And that's what that percentage number is very, very important, right? So anything above 0% starts to be healthy, right? But what is important in terms of consistency in growing companies especially is how frequently you actually want to meet the target and how consistent is that target. A company that in 1 year delivers 90% and then in the second year delivers 50%, investors are going to look into, right? Why have I only delivered 50% in the second year? Is there something that's clear, right? So that's the very, very important, and sometimes the fixation that established companies have, especially when they want to look to keep on thriving throughout the years.
Okay, so just for the sake of our understanding to us all, free cash flow and net earning, the difference is in the free cash flow, you don't take into account the non-cash expenses that you would for the net earnings, such as depreciation, amortization, unrealized gains or loss. And this will allow you to look at from a cash flow standpoint, where do you sit compared to the net earnings when you take everything into account. But thank you, Daniel. That's super clear. What does that mean at the group level and project management level? We have this free cash flow productivity, this percentage that is very important for the shareholder returns. That's something you mentioned quite a lot, quite sometimes in this episode. How does that translate into what you need to do at group level and project management level?
So big companies normally don't rely on one single product or even one single type of product, right? So there is the tendency to organize into subcategories, sub-companies, however you want to call it, legal entities, right? So the group level has a specific target, right? But that specific target is the contribution of each of the team players, right? So that cascades down from what the company itself, which is showing the face to the investors, can count on the different parties that are in it. So that then cascades into the different groups. So it can be in FMCG companies, it can be the biscuit group, it can be the laundry group, and it can be the diapers group, right? And then inside those groups themselves, you have people, as I mentioned before, right? You have there's a global setup, there's a regional setup, there's a national setup, right? So, and as it cascades down, that's where the information needs to be passed down to the single individual who is managing a capital project to understand what his or her role is in contributing and achieving that target.
Okay. And hence the importance of those daily, weekly, monthly, quarterly review of the cash going in, and the cash going out, especially compared to what's going in.
And just to make sure that it's not over-intellectualized, right? I mean, the practical point of view is it's not that each project, the individual knows their specific contribution, but what's important is they know their target for that year or for that quarter, and the targets of his or her partners will all add up to delivering that, right? If one of them starts failing or there's the inability to compensate, you're going to miss out on your target.
Okay.
That's interesting. So like such a big company structure, it's really you're a project manager, you have another project management in your department, let's say. You try and compensate between the two of you for your for your team's, let's say, cash flow targets. If that doesn't work, maybe you go one level up, see if you can compensate there. If that doesn't work, you go one level up. Eventually, if you get to the global level and you can't compensate, then you're screwed.
Yeah, ideally you've told that early enough, right? But that's why it's important, the weekly, the monthly.
That's interesting you touch on told it early enough. Do you also I guess then, because we said about spending is important or spending targets are important because you're releasing that cash or not to the company to spend in other ways. So I guess you also need to be rewarded if you are able to spend less because you managed to do something in a cheaper way, for example. You want to tell the company as early as possible in the fiscal year that, hey, either you can give this cash to another project or you can overall restate. Do you restate ever your cash flow targets?
They can be restated internally. They can be restated, right? Externally, the company decides whether to restate them or not on the quarterly basis, right? When they have either their shareholder court or their quarterly earnings calls, right? That can be a moment in which restatements can happen. If you look at it, I mean, not talking FMCG now, but if you look at in the past 6 to 9 months, throughout quarter 1 and quarter 2, especially in 2022, a lot of companies have restated what their earnings would be. Not necessarily free cash flow, but all of that has an impact on it, right? So that can happen. Not desired, obviously.
I mean, FMCG by nature is a very dynamic market, right? So demand can spike or drop off within a year. And assuming maybe you want to delay some projects because you say, hey, not worth the investment because we look at our demand profile now and it's just not there anymore. But it would have to be quite a big shift, I guess, to be able to
It'd have
justify.
to be a very, very, very big shift. Typically, capital projects would not be the single reason for that shift, right? Typically, these are external, right? It's a war, it's commodities, it's pandemic. It can be a series of things.
Very clear. Anything else you want to touch on in overall how your role or the roles that you've worked in or the departments that you've worked in influence the treasury of a large company?
The only thing, I mean, the last thing that I really like to drop off is in working in an FMCG company, you probably don't realize that when you start, but as you grow, as you understand what spending capital means, right, and having access to that project and what the impact is that on weekly, monthly, quarterly spending, it's something that will grow with you, right? Okay. From my experience from a corporate treasury and what I've learned over the past years and what we talked about here is I'd recommend everyone to take it and do it personally.
Okay.
Do it personally, because if we manage our finances like a good corporation manages their treasury, that's halfway to our success.
So your cash flows, keeping them positive, setting yourself a spending target and sticking to it.
Indeed. Finding ways to compensate. Yes, that's what I would say. That's the last thing that I'd really like to leave, especially on this topic. Right? Is whatever a lot of the things that you guys talk about are actually applicable also to the individual, and it's something that's super important.
Super interesting. Daniel, thank you so much for your expertise.
Thanks
a lot. It's been great, guys. Thank you.